What's going on, everyone? It's your boy Kenny Trades from Trading Made Simple TMS Trading. In today's video, we're going to be going over a credit spread strategy, aka the credit vertical. And so in this instance, we're going to be using our virtual account just to show you kind of the power of spreads in a really volatile market. In this case, we're going to look at Walmart. We kind of already saw this setup happen. And so in the way that we're going to explain this is, you can obviously see Walmart has some increase price action here. It's trading about 153.61 as of November 28th, 11:42 a.m. Currently, we have the price action frozen, but you can see that the volume here, it's actually showing some divergence in the price action. Rising price action, falling volume. Typically, that's hidden bearish divergence, and once selling pressure increases, the price action changes dramatic direction. In this example, you can see that there's actually a gap between 142.75 and roughly 145. So in this case, we are very bearish, for example, that Walmart will eventually come down into price action and most likely fill that gap, right? You can see that our option buying power here is 100K. We're going to pretend like we're using a account of $1,000. And so in this example, what we're going to do is we're actually going to look at the Walmart option chain. You can see that we're going to go to the monthly option for this strategy, and we're going to want to target that 145 as our target to the downside, or actually in this case, let's say 146.58, so that if it does get to 145 or in the gap, it is actually going to be in the money. So in order to do this strategy, you're going to go to trade, you're going to go to the options chain, and in this case, we're going to actually sell on the call side the vertical. So we're going to go to the 145 strike. Let's say that that's the target we want. So we're going to click that. Going to go to sell. Remember, this is on the call side because we are technically bearish. So getting a selling on the call side is equivalent to being bearish, as is selling on the put side is equivalent to being bullish. In this case, we're bearish. So we're going to sell the vertical here at 145, and we're going to sell the 145. We're going to buy the 146 as insurance. Currently, the credit is about 87 cents per contract. In this case, let's say that we're going to use a full $100 worth of risk. We're going to add up to 10 spreads here, or 10 contracts per spread. And we're going to, let's see, play the market a little bit here so that we could see what's happening with the price action in just a second. So as you can see, price is still going up, but we are seeing that we got a wick away from this 154.89. Our current trade strategy has a credit of 87 cents. We're going to go ahead and see if we can get a fill for 90 cents to make it even and easier to understand. All right, so while we're waiting for this to play out, we're actually it takes a little bit longer to get filled on spreads. So as you can see, we got filled now, obviously, for the 90 cents per leg. So this is what the actual trade looks like. Notice your buying power first. We started with 100K. Technically, if you take out these numbers of the 100,000 or 99,000, we would have started with a $1,000 account. We risked $100 in this instance, and we got an immediate credit of $900, right? So our buying power effect has reduced by 1,000 because that's the collateral we're putting into the trade, and we're actually, our drawdown here is going to be maximum loss would be $100 for a max reward of 900 in the event that the trade works out the way we want it to. What we're going to do here is, as you can see, in this spread, we're going to actually fast forward on the chart and go forward to see what the price action looks like in a few days. And we're probably just going to hop to somewhere in December, maybe like the 9th and the 15th. So we'll be right back. All right, so now we are actually at December 9th. It's roughly the same time, but we're actually a week forward into the future. Pretty cool how we can do this on the on-demand feature. The price action of Walmart has actually hit the first target that we wanted to, which is around 146.5. And obviously the chart has sold off. The divergence worked. You could see the volume increase in selling pressure, which drove the price lower. And if we look at our position, you can see that we're actually up 25% on the trade, and we're up $220, right? Keep in mind, we've only risked about $100 to the downside, if you will, if this trade did not work out, versus the maximum profit of 900. Now that this has worked out, we're going to fast forward just a little bit further to see what it looks like the day or close to the day of expiration. All right, so here we are, December 15th, the day before expiration on the contracts or in the trade, right? It's 11:45, roughly still the same time, doesn't matter. Obviously, nothing has changed in our account outside of risking $100 for a possible $900 credit. The price action of Walmart, as you can see, has dramatically increased to the downside and actually has hit this target and hit the gap fill. Remember, now if we look to the trade, we could see in the option chain that our strike price or our position here is in black or out of the money. When you are doing a call credit spread, which is bearish, you want these to expire as worthless or as close to zero as possible. Now that these are at almost expiration and they're out of the money, it is most likely that the value of these will diminish to zero. Why is that a benefit? Because when you look at your trade, you'll see that our P&L on the spread has increased significantly because now we can actually sell back the spread for a profit. Currently, you can now see that the position is up 81%. We've now profited $735. And in this case, you could see that one leg, being the sell side, has increased by almost 100%, which is 96% here. Whereas the call, where you would have actually bought the options or that leg, is practically zero or minus 98%. The difference in value gives you your actual credit and or profit. So in this case, what we're going to do is we're going to actually let the simulation play out. Let's say that you actually are okay with the amount of profit that you've put into this trade. It's been about 3 weeks. You came back and now you're up 81%. We're going to actually go ahead and close the order by right-clicking the chain on the instrument, buying back the actual spread at a cheaper debit. Now, if we pause this here, there's one of two things to note. If you were to wait till expiration and Walmart is still trading at a price of $143 and is under the sell leg, then this will actually give you a 100% return at 4 p.m. Eastern when the market closes. Why? Because both of the contracts expired worthless and you've received the full credit. But if for some reason you feel that the price action could bounce or it might bounce or you don't want to risk it, you can always close the spread ahead of time once you're okay with the profit gain that you get. In this case, that's what we're going to do. Now, keep in mind, in our cash sweep vehicle, we have received the full credit ahead of time when we open the position of $900. So what we're actually doing is giving back and buying back this spread with the collateral that was already given that will come out of the credit. So in this case, to close this, it would cost about $170 of the $900 we've received. That's why you see the max credit has, or max profit technically changes. We're going to go ahead and actually press play here. And then we're going to go to our position here and close it out completely at whatever price it wants to. At this case, it's at 19 cents. So now you can see we've actually profited out of the 900, $710. We've used $1,000 worth of buying power collateral, which we have now received back. And there was no loss on this. This trade ended up netting us $700. Keep in mind, the maximum loss value that we were risking was $100. We have now made $700, which is practically a 7R risk to reward ratio. And in this case, a beautiful trade. If you like the content you're seeing, feel free to drop some comments down below on what you want to see next. And if you have any questions, feel free to hit those comments. Give a like and subscribe, and we'll see you in the next one. Peace.